Hi class. Today we're going to review some questions for the final exam. But first we're going to go over the final exam outline that I sent you. So the exam is going to be held this Friday, June 26th at sharp at 8 a.m. It's available between 8 and 8:30 a.m. After that, you won't be able to get in, so you need to get in before 8:30. I prefer you to get in right at 8 a.m. Once you're in, you have 2 hours to complete the test. The coverage will be on chapters 3 to 11, but the vast majority of questions will be from the post-midterm material, that is chapter 8 through 11. So the exam is going to have 50 multiple choice questions, and it's going to be a rough balance of knowledge-based questions and application-based questions. So there you could be given a graph or a table and have to do some calculation. You must complete the mandatory lockdown browser quiz. Probably all of you have done this already for the midterm. If you haven't, then you will have to do that if for some reason you missed the midterm. If you have any issues with the lockdown browser, there's a link here, and I've sent this to you in the PDF document for the final exam outline, so you also have that link. You can click here and log a support ticket. So the exam is closed book. I just emailed you a formula sheet that you could print and use during the test, and the final exam is worth 40% of your grade. And please make sure you are up at 8 a.m. Friday morning and ready to write the test. If you have some kind of an illness, you'll need to have a valid doctor's note to write a deferred exam. So in order to prepare for the final, I suggest that you complete the practice or the end of chapter problems. There are solutions posted on Slate. They're called Study Problems Textbook. They're under this heading here. You should also review the in-class exercises that we covered in class. And I also have a set of exam practice problem sets that are posted on Slate, and all of these have solutions. Okay, and you also have detailed learning outcomes that I sent you in the email in the outline. You could perhaps use that as a checklist to make sure that you cover all of the topics. And I mean, you already know this, but just memorizing content isn't an optimal study strategy. You actually need to fully understand the concepts and be able to apply them to practical questions. Where do you find the final exam? If you go under assessments, quizzes, you will see the final exam listed here. Okay, and again, it starts Friday morning, June 26th at 8 a.m. I also just want to point out that there are practice multiple choice questions on the Connect platform. If you go into the Connect platform, you can see that there's things called self-check exercises. So these are practice multiple choice questions that you can do, and you can do all the way from chapter 3 to chapter 11. So again, the midterm will be on 3 to 11. However, most of the questions will be from 8 to 11. Okay? So I'm actually going to go over some multiple choice questions in this lecture video. So the first question I have for you states, in the simple macroeconomic model, autonomous expenditures are. So for these, I think you should hit pause, think about the answer, and then I will show you the answer, okay? So hit pause. Okay, so we're back. So autonomous expenditures, which is the correct answer? Well, if they're autonomous, that means they don't change with national income. So the correct answer here is E. Now in this question, we have the consumption function plotted here in a 45-degree line. And we're asked, if disposable income is $3,000, what would the consumption be? Okay, hit pause. So in this case, the consumption will be equal to 2,000. Basically, we're just going to be plugging in 3,000 into our consumption function, and it will tell us what the consumption is. We could do that if we had the equation, or we can also do it from the graph. So in this case, at 3,000, the amount of consumption is equal to 2,000. Next question. The marginal propensity to consume is defined as, which one of the following is correct? Hit pause. Okay, well, we know that the marginal propensity to consume is how much we consume out of our income. And it's a certain fraction that's usually less than 1, because we either save the rest, or if we were thinking more generally of the marginal propensity to expend, we would be importing or also giving some of our money to the government in the form of taxes. In this case, the answer is E. It's the change in desired consumption divided by the change in disposable income. So remember, the marginal propensity to consume is the slope of the consumption function. The marginal propensity to expend is the slope of the aggregate expenditures function. and they will be different if we have government and trade in the model. So the next question here says that the Smiths family disposable income rose from $40,000 per year to $42,000, and their desired consumption expenditure rose from $38,000 to $39,600. It can be concluded then that which is the correct answer. So you might want to hit pause and see if you can figure it out. Okay, so the correct answer is 0.8. If we take this difference here, the change in the consumption, and divide it by the change in income, we will get 0.8. Next question. So here we have our aggregate expenditures model, or the Keynesian cross. We have our 45-degree line, and we have two aggregate expenditures curves. And it says, assuming that AE0, this one here, is the prevailing aggregate expenditures function, the distance 0A is a measure of, so hit pause. Okay, well, the correct answer here is B, autonomous desired expenditure. If you remember, the intercept of the aggregate expenditure function would be how much the household or the country would want to spend even if their income is zero. So it doesn't depend on income. Now we have the same diagram, and it's saying now a shift in the aggregate expenditure function from AE0 to AE1 could be caused by which of the following? Hit pause. Okay, we're back. So here we have a shift upwards in the aggregate expenditures function. So what could do that? Well, if there's some change in autonomous expenditure. So the answer here is an increase in desired investment expenditures. This is the only answer of all of these that is correct. If there's a change in, say, the marginal propensity to consume, that would actually rotate the line rather than shift it in a parallel manner. Like, now consider the simplest macro model. Okay, let's consider an economy that's characterized as follows. This is a closed economy and there's no government, so income is just equal to consumption plus investment. The consumption function is equal to 100 plus 0.6y, and investment is equal to 200. Okay, so hit pause and try and figure out what the equilibrium level of national income is. Okay, so the answer is 750. The answer is 750. So in order to do this, we need to substitute in the consumption function and investment into here, and then we simplify it, set AE equal to Y, and then solve for big Y. And when you do that, you will get 750. So given the same information, what would be the simple multiplier in this economy? So hit pause. Well, here the answer will be 2.5. So remember, the multiplier is, in this situation, will be 1 over the marginal propensity to expend. Here, that's the same as the marginal propensity to consume because we don't have government or trade. It's a closed economy. And so we're going to take 1 over 1 minus 0.6, which will equal 2.5. This here is exactly how you would calculate 2.5. Now, in this question, we're going to go through the full model and solve for the equilibrium income. Okay, so here we're given the consumption function, we're given investment, we're given government spending, we're given net exports, and we're given the tax function. So the first thing we need to do is remember that our aggregate expenditures function is equal to C plus I plus G plus X minus M. And then we're going to substitute the information shown here into this expression. So the consumption function is this, so we're simply putting that here. Then we're going to add 75, which is investment, then 51, which is government spending, and then 72, which is the autonomous exports, and then we're going to put minus 0.1y. So this whole expression here is net exports. Now, we need to get rid of this y subscript d. This is disposable income. We want everything in terms of national income, big Y, before tax, and before any savings. So disposable income is equal to y minus t. It's just the income after you pay your taxes. Okay, so we can rewrite that as y minus 0.1y. Negative 0.1y is just the tax function. Okay, so we're putting that in there, and then we just simplify it. You have 1y, but you owe 0.1y, so you have 0.9y. Okay, so now we take this and substitute that back into there. So now our aggregate expenditures function is 30 plus this here, which is the 0.8 times disposable income, and plus the rest of the terms on the right. And now we just simplify everything and we get 228 plus 0.62y. And we know that in equilibrium, the aggregate expenditures equals income, and that's how we would solve for the equilibrium level of income. And that's what we will do now. So we're going to set AE equal to Y, and then once we do that, we know that the Y that we solve for will be the equilibriums. That's why there's a star on it. And we solve this, so all we're going to do is isolate Y. So we're going to bring that over here. We have 1y, but we owe 0.62y, so we have 0.8y left over. That equals 228. We divide, and we get that the equilibrium level of income is 600. What does this look like on a diagram? Well, here's our 45-degree line. We have our aggregate expenditures. We have our income or real GDP on the horizontal axis. When we plot our AE function, which is this here that we just derived, we see that it intersects the 45-degree line at 600, which is exactly what the equilibrium level is. In this question, we're told to consider the government's budget balance. Suppose the government spending is 300 and the government's net tax revenue is equal to 0.14y. When y is equal to 2,000, the government is running a budget. So what is the correct answer? So hit pause and read the hint here. Okay, we're back. So the correct answer here is a deficit of 20. How do we get that? Well, we know that the budget is equal to net tax revenue minus G. And we were told that net tax revenue is 0.14 times Y minus G. So we just plug in the 2,000 that we're told in the question, and we get that it's negative 20. In this question, it's saying that the aggregate expenditures function for an open economy with government can be written as which one of the following is correct. So hit pause. Okay, the correct answer here is B. And you should have already known the answer here because we used this in the previous question. So here we have a diagram. It's showing us the aggregate expenditures function, 45-degree line. It's showing investment, and it's also showing investment plus government spending. Okay, here are the features of this economy. The marginal propensity to consume is 0.75. The net tax rate is 0.2. There's no trade. There's a fixed price level, which is always true when we're looking at Keynesian cross diagram, and then all of the expenditures and income figures are in billions of dollars. So which of the following equations describes the aggregate expenditures function for this economy? So you want to hit pause and spend a few minutes trying to figure this out. Okay, so the correct answer is D. How did we get this? Well, consumption is equal to 75 plus 0.75 times disposable income. Okay, we are told this in the question that the marginal propensity to consume is 0.75. Okay, and we know that by looking at this diagram, we know that aggregate expenditures is equal to C plus I plus G. There's no trade. Okay, so the difference between here and these two things is going to be the intercept of the consumption function, right? We're going to take 250, we're going to subtract off the 175, and what we're left with is 75, and that's going to be the intercept of the consumption function. Okay, so when we work this out and substitute in for disposable income, we will get this expression here, and we just simplify everything, collect like terms, and the answer is equal to 75 plus 0.6y. And so this would be the actual consumption function for this economy. So this is the consumption function, but we still need to go back and add in our 175, which is I plus G. So 175 plus 75 gives us the 250. Okay, and we know the slope is 0.6y. Okay, next question. We're given this table. This has all of the information for the full model. So we have our national income, taxes, disposable income, consumption, savings, investment, government spending, exports, imports, net exports, and aggregate expenditures. So the question is, what is the value of the expenditures equilibrium? Hit pause. Okay, well, the answer here is equal to 500. How do we know that? Well, we're going to look for where income is equal to aggregate expenditure. Next question. So we have the same table, and we are asked what the value of the multiplier is. So hit pause. Okay, so the value of the multiplier here is equal to 2. Well, how do we get that? Well, recall that the slope of the aggregate expenditures function is we use that to get the multiplier. We do 1 over 1 minus marginal propensity to expend, and the marginal propensity to expend is the slope of the AE function. So We could do that, and then we could easily see here that the slope is 0.5, right? We know it's going to be linear, so we know that the difference here between all of these figures is going to be 50, and we know income here on the left goes up by increments of 100. So when this changes by 100, this changes by 50, so the slope must be 0.5. And then we can do 1 over 1 minus 0.5 will equal 1 over 0.5, which is equal to 2. Okay, or we can also just take the difference, but the best way to do it, actually, and indicated here, is how you would calculate. So again, the slope of the AE function would be 0.5, and then when we use our multiplier formula, we'll get that the answer is equal to 2. So the aggregate demand curve relates the price level to which of the following? Hit pause. Okay, so if you remember in the diagram, we had the price level on the vertical axis, and on the horizontal axis we had real GDP. And so the AD curve relates the price level to the level of real GDP. Okay, so we have here a diagram where we have an aggregate expenditures function. We have AE1, AE0, and it's telling us that there's an exogenous increase in the price level. That's going to cause the AE0 to shift downwards from AE1. And so here the equilibrium would change from E0 to E1, and real GDP would fall from Y0 to Y1. So this is just reviewing what goes on if we actually have a change in the price level. If you remember, we derived the aggregate demand curve at the end of our lecture on this topic. And so you could think of the price level as being higher here. So you can think of P0 being associated with this aggregate expenditures curve, and P1, which is a higher number, associated with this. The reason why this shifts down is that if prices were to double, all else constant, then of course you're going to be spending less. And in this case, we would begin here at this level of real GDP, but it will fall to this level here, Y1, due to that change in the price level. And then we could plot the different price levels and incomes on a diagram, and we would trace out the aggregate demand. So given that discussion, let's try and do this question here. It looks very scary, but it's actually quite easy. So here it's saying, assume the economy is initially in equilibrium with aggregate expenditures equal to real GDP at point V. Okay, so we're initially here. The price level associated with AE0 is P0. Other things being equal, exogenous changes in the price level will cause. Okay, so what is the correct answer here? So I'll give you a minute to think about that. So hit pause. So the correct answer is D. Okay, so shifts in the aggregate expenditures function here due to changes in price levels will correspond to a movement along the aggregate demand curve. So for example, at this point, when the price level is P0, we have that output is Y0. So Y0, P0 corresponds to point B. If we look at this point U, and at U, the price level would be P1, so it had increased. So here is P1. So what's the level of income at P1? Well, it's Y1. So we go over and we see Y1. So we're moving along the aggregate demand curve. Okay, so if you don't fully get this, you should review the slide in the lecture notes for aggregate expenditures that derives the aggregate demand curve. It's the last slide, I believe, in the lectures. Next question, which of the following would cause a leftward shift in the aggregate demand curve? Hit pause. Okay, well, the correct answer is B, a decrease in autonomous government purchases. If you remember, that would shift the aggregate expenditures curve down, which means that would cause the aggregate demand curve to shift. Okay, in this case, we're not talking about changes in prices like we just did. We're talking about changes in an autonomous item like government purchases. If we had a decrease in investment spending, that would do the same thing, okay? These other things would not correspond to a leftward shift in the aggregate demand curve. So the economy's aggregate supply curve shows the relationship between what? Okay, hit pause and try and figure out the correct answer. Okay, so if you remember, the aggregate supply curve is drawn in the price level and real GDP space, and it's upward sloping. Okay, so it's telling us the relationship between the price level and the total output that firms wish to produce and sell as technology and input prices. This says vary. Okay, so now we know that when we draw an aggregate supply curve that we're holding fixed these things. So E cannot be the correct answer. We know D is not the correct answer, and we know that it has to be a relationship between the price level and something, so we're left with B. And B makes sense because it indicates that the input prices are held constant. So here B is the correct answer. In the short run, the aggregate supply curve has a positive slope because as the price level rises, producers can. So just think about it. If input prices are held constant, and the firm can get, sell the good for a higher price, they're going to make more profit, right? So which one here is the correct answer? Hit pause. Okay, I'm back. The correct answer, of course, is B. It would increase output at unchanged unit costs. So they would make more profit if that's the case. And so they'd want to offer more for sale. So here we have on this diagram a shift to the left in the aggregate supply curve. And it's saying which of the following events could cause such a shift. So hit pause. Okay, I'm back. The correct answer here is C. So out of all of these answers, the only one that would correspond to a shift to the left in the aggregate supply curve would be a massive drought that reduces agriculture output. So here we have some sort of an environmental catastrophe or something like that. Then of course at every price level, firms are going to be offering less for sale. There's just less production that's going to be done. Okay, for E, a major discovery of new oil, that would shift it to the right. A decrease in business confidence that reduces desired investment. Here we're talking more about the aggregate demand curve. And A, improvements of communication technology, well, that would shift it to the right. Okay, and then a recession in the US that reduces our net exports, that would be something related to the aggregate demand curve, and it would shift the aggregate demand curve to the left, not the aggregate supply curve. Okay, so the macroeconomic equilibrium, this is where this is where the aggregate demand curve and aggregate supply curve intersect. And so which of these is correct related to that? Hit pause. Okay, the correct answer here is real GDP and price level that is on both the aggregate demand curve and aggregate supply curve. So that's where they would intersect. Okay, next question. Refer to this figure here. We have an aggregate demand curve and an aggregate supply curve. Suppose the Canadian economy is initially at point A here. An unexpected shock then shifts both the aggregate demand and aggregate supply curves as shown and results in a new equilibrium at point B. So which of the following events could cause such a shock? Okay, so here we have both curves shifting. So which one of these could be responsible? Okay, the correct answer is E, a decrease in the world price of oil. So in this case, this type of a change would affect the supply side, right? Because oil is an input, and it's also used to make gasoline, and a lot of goods need to be delivered to their final place of sale. So on the supply side, this now is cheaper, so that would represent a shift to the right in the aggregate supply curve. But on the other hand, the aggregate demand curve would shift to the left. And this could be, for example, in Canada, because of our net exports falling, because we're a net exporter of oil. Although that wasn't specifically said in the question, it's the only solution here that makes sense. So here's this diagram again, except here we just have the aggregate demand curve shift. And it's saying, suppose that an increase in government purchase was the cause of this aggregate demand curve shifting to the right. If the simple multiplier in this economy is 5, then how much was the increase in government purchases? So hit pause and think about this for a sec. So here the correct answer is 40. How do we know that? Well, we know that the shift to the right in the aggregate demand curve went from, if we were to hold prices constant, from A to B, okay? And so we have this difference here, which is 200. But we know the multiplier is 5. So if we take 200 and divide it by 5, we get 40. So if you think back to the Keynesian cross aggregate expenditures diagram, we would have that the aggregate expenditures curve shifted by 40 because of government purchases, and then the new equilibrium value would have changed by 200 in total because the multiplier is equal to 5. And again, 200 divided by 5 is equal. Okay, now let's switch over to our chapter on money. Which of the following is a common definition of money? Hit pause. Okay, well, we know that the answer is B. So in order for something to be considered money, it needs to be generally acceptable. That's the most important characteristic, and its main function is that it's a medium of exchange. What is the biggest disadvantage of a barter system? If you recall, a barter system is a system where we wouldn't have any money, and so in order to trade, we would need to find something that someone has that we want to have in the right quantities. Okay, so this question's asking what the biggest disadvantage of this type of barter system would be compared to if we were actually able to use money. So hit pause. Okay, the correct answer here is D. The biggest problem is that each trade requires a double coincidence of wants. What is the main reason that fiat money has value? And again, fiat money is like what we use, where the government just declares it as the currency that we're going to use in the country. It's not backed by any precious metals at all. Okay, so hit pause and think about what the correct answer is. Okay, the correct answer here is, again, A. The most important characteristic for something to be considered money is that it's generally accepted. And we generally accept that the Canadian dollar is our currency, and so it is, in effect, it is money. Strengthening that a little bit is the legal tender requirement, but you could still have legal tender, and if no one generally accepted it, it wouldn't be considered money. Now let's think about Bitcoin. So Bitcoin will not be considered money unless which of the following conditions is satisfied? Hit pause. Okay, so what is the correct answer here? So the correct answer is A. It needs to be generally accepted. So we're really trying to drive home that generally accepted concept. So it needs to be generally accepted, and you need to be able to use it as a medium of exchange, a store of value, and a unit of account, because these are the essential functions of money. What would you say the largest element of the Canadian money supply is today? Okay, so the correct answer here is E. It would be demand deposits. So typically we think of the money supply as demand deposits and currency in circulation, so the paper notes and coins. And we know that the amount of demand deposits is much larger than the paper notes and coin. If you remember from our lecture notes, the difference for a particular year not that long ago was something like this, and these are in billions of dollars. So the demand deposits are much larger. Commercial banks in Canada are prohibited by law from which one of the following here is correct? So think about the lecture notes on this topic and think about which one is correct here. Hit pause. Okay, so in terms of A is not the right answer because we know that this is true. Don't dwell too much on this. We didn't talk about a clearinghouse, but this sort of thing is what is actually done. Now, commercial banks, we know, can lend money to households and firms. There's nothing preventing them from doing that. We know they can accept demand deposits. We know they can accept term deposits. The one thing here that's questionable is C, issuing paper currency. Well, we know that only the Bank of Canada can do that. So the correct answer here is C. Let's consider a new deposit of $10,000 to the Canadian banking system. Okay, so we're assuming this is a new money that's not already in the system. So the bank initially receives this deposit, will find itself with A. Which one of these is correct? So you might want to remember your formula for what access reserves are. Okay, so here the correct answer is 8,000. Okay, so if the target reserve ratio or desired reserve ratio is 20%, then they're going to want to hold on to 20% of this new deposit. And then the rest will be access reserves that they could lend out. What is a commercial bank's target or desired reserve ratio? So hit pause. Okay, so the correct answer here is D. It's the fraction of deposit liabilities that it wishes to hold as reserves, either as cash or as deposits with the Bank of Canada. Suppose a commercial bank has a level of target reserves of 500 million and actual reserves of 575 million. This bank's blank is 75 million. So what's the correct answer here? Hit pause. Okay, I'm back. And so the correct answer here is excess reserves. So this bank's excess reserves would be 75 million because this is their target and this is what they actually have. So the difference would be the amount that they have in excess of their target. Okay, so it's good to make sure you know these formulas. Okay, so refer to this table here. So we have a balance sheet. We have our assets on the left, reserves, loans. On the right, we have liabilities. These are our deposits, and then we have cap. And it says here that the Bank North is operating with no excess reserves. So if they're operating with no excess reserves, what is their actual reserve ratio or their target reserve ratio? We can figure that out because we're told that they don't have any excess. So I'll give you a second to think about how you get that answer. Okay, so the correct answer here is 15. Well, how do we get that? Well, we know that their deposits are 2,000, so we just need to figure out what percentage of 2,000 equals 300. And because we know that this amount of reserves here is their actual reserves, and it's also equal to their target reserves. Okay, and so if we think about that, we will see that if we multiply 2,000 by 15%, we will get 300. Suppose you found a $100 bill that was lost for many years under your grandmother's mattress, and you decided to deposit this money in a commercial bank. If the target reserve ratio were 20% and all excess reserves were lent out, your new deposit of $100 would lead to an eventual expansion of the money supply of how much? How do we calculate that? So hit pause and try and figure this out. Okay, I'm back. And so in this case, the answer would be 500. How do we get that? Well, we know the multiplier is equal to 1 divided by 0.2. And so we're just going to take that amount and, so we're going to take the 500, multiply it by 5, and that will equal 100. And that's the total possible amount. Now suppose that all the banks in the banking system collectively have 20 million in cash reserves and have a target reserve ratio of 5%. The maximum amount of deposits the banking system can support is, so hit pause. Okay, so the answer to this question is E. How do we get that? Well, we know the multiplier here is going to be 20, so quite large. And so we're going to take the 20 that are in excess reserves, multiply it by the multiplier, which is also 20, and we get 400 million. Okay, next question. The term demand for money usually refers to which of the following is true? Hit pause. Okay, the correct answer here is A, the aggregate demand for money balances in the economy. So that's what we are saying the demand for money is. It's the overall aggregate demand. It's how much people want to hold of M1, okay, which are money balances. And remember that the demand for money can consist of the transactions demand and the asset demand for money. The opportunity cost of holding money, so that's what you have to give up, rather than bonds, is which one of these responses? Okay, hit pause. Okay, now when you hold on to money in your demand deposit or in your pockets, you're not getting any return on those. So that is the opportunity cost. So basically, the answer to this question is A, which is the rate of interest earned on bonds. If you don't have your money in bonds, you're giving up this interest rate. And so that's the price of holding money. The transactions demand for money arises from the fact that which one of these is true. Hit pause. Okay, the correct answer here is D. And if you remember from the lecture, the transactions demand for money relates to how much money people want to hold in order to make purchases of goods and services. You need money in your checking account or in your pocket to be able to make purchases. So that's what we're referring to when we talk about the transactions demand for money. If we assume there's just two assets, money and bonds, and that's the assumption we made when we looked at our simple money market model in the lecture, we can expect that an individual with a given level of wealth will, so hit pause and try and answer this question. Which of these responses is the best? Okay, well, the correct answer here is E. Hold more money than the current interest rate is very low. So with an individual with a given level of wealth will want to hold more money when the current interest rate is very low. The lower the interest rate, the lower the opportunity cost of having your money in bonds. consider the money demand function. If the general price level were to increase, other things being equal, the money demand function would, so hit pause and see if you can figure out which answer is correct. Okay, well the correct answer here is E. It would shift to the right. If you remember, the money demand is a function of income, interest rates, and the overall price level. If the price level were to increase, all else constant, then we need to have more money because all prices have increased. So we would represent that by a shift to the right. Okay, and so if you remember from the notes, money demand is a function of the interest rate, and it's related in a negative way, income and price. Okay, so here is a diagram of the money market. We got the quantity of money on the horizontal axis, the interest rate on the vertical axis, and this is our equilibrium. Suppose that the market interest rate is I subscript 1. So that's here being indicated with this line here. The situation in this market would be as follows. So which of the responses here is correct? Hit pause and think about the answer. Okay, the correct answer is D. Firms and households would be attempting to increase their money holdings by selling bonds. So we have an interest rate that's below the equilibrium. We know at the equilibrium, the quantity demanded and supplied would be equal, but below the equilibrium, the supply, which is fixed at M0, would be less than what the demand for money is. With this lower interest rate, people aren't as interested in holding bonds. They'd rather have some more of their money, in either their checking account or in currency. And so here we would have excess demand. And so in this case, people would need to be selling bonds in order to get that liquidity that they need. And that would actually cause the interest rate to increase again until we get back up. So this question here just looks at the relationship between the money supply and the investment demand curve. You remember the monetary transmission mechanism that we learned? So here we're saying that there's an increase in the money supply from MS0 to MS1. So that's shifting to the right. So going from M0 to M1, and that's going to shift the monetary equilibrium from E0 to E1. The result is, which one of these is the result? Hit pause. Okay, well, when the money supply increases, that's going to push down the interest rate, and that will increase investment. We will move along the investment demand curve. And so the correct answer here is D. Which one of the following statements best describes the monetary transmission mechanism? Okay, hit pause. Okay, we're back. So here the correct answer is D. Okay, again, it's an increase in the money supply that leads to a lower interest rate, higher desired investment, and an upward shift in the AE curve, and a higher GDP. And that'll also shift the aggregate demand curve to the right. Okay, so here's a little summary. This is from a different textbook, but it's the same idea. This is a good summary of the transmission mechanism. Okay, so here we have another scary diagram, but it's not so bad. So we have the economy beginning in equilibrium with MS0 and MS1 and real GDP equal to potential GDP. Okay, and that's where AD0 and AS0 are. So our starting point then here is MS0 and MD0. Okay, so when we're at the interest rate of 4% in the money market, that will correspond to us producing 800 real GDP and being at the intersection of AD0 and AS0. So this intersection point here. And it's saying at this initial equilibrium, the money supply is fill in the blank, the interest rate is fill in the blank, the price level is fill in the blank, and real GDP is fill in the blank. So I'll give you a second to figure that out. Okay, so we know that the interest rate is 4%. Okay, we know the quantity of money is 500. We know that the price level is 100 and real GDP is 800. And so the correct answer is D. Now again, we have this diagram, and now we're told that there is an increase in the money supply to 540. So we have our money supply curve shifting to the right. And so what's the initial response in this economy? So I'll give you a sec to answer. Okay, so if the money supply increases, as indicated here, the new equilibrium in the money market will be where this intersects the money demand curve. So we will end up with the interest rate falling from 4% to 2%. But this question is asking what's the initial response. So the initial response will be indicated by answer A. We will have a movement down along the money demand curve to the lower interest rate at 2%. So that's precisely what I mentioned before. If it wasn't clear what the question was asking, if initially meant without the interest rate changing, then at this old interest rate, we would have the money supply here, but then the money demand only here, so we would have a surplus of money. But in this case, they're just referring to this initial change in the money market, which would be a movement down the money demand curve. So the interest rate will go from 4% to 2%. What's the overnight rate? So what is the best answer of these four? Hit pause. Okay, the answer is the interest rate on loans of reserves from one bank to another. And they're very, very short run. They're, at the end of the day, some banks owe each other money. So some need to borrow, some have excess, and so that creates an overnight market. That's what the overnight rate is. It's referring to the price of money in that overnight market. In general, if a central bank chooses to target the interest rate in its implementation of monetary policy, then which of the following is correct? Okay, the correct answer here is C. It will conduct the necessary open market operations to accommodate the resulting change in money demand. So here they're going to be targeting the interest rate, not the money supply, and they'll just change the money, they'll do their best to accommodate the changes in the money supply to get the target rate that they're interested in. In practice, we know it's not possible for the Bank of Canada to control the money supply precisely. We learned about this, and what did we learn? Do you remember why this is true? Hit pause and think about the answer. Okay, so the correct answer is A. Of course, the commercial banks decide how much of their excess reserves to lend out, and that is part of the whole money creation process. Okay? In Canada, what are open market operations? Okay, so what is the best answer? Hit pause. Okay, the correct answer is C. It's the buying and selling of government securities by the Bank of Canada. And I just put here some review notes for you so you can take a look. So this is a good diagram to go through. It shows you the steps in terms of open market operations. In this case, the Bank of Canada is buying a T-bill from a corporation. And when the Bank of Canada buys securities on the open market, they increase the money supply. Okay, so we have two diagrams here of the money demand curve, okay, and then in the second one we have the money supply curve. The first one here is referring to targeting the interest rate, okay, and then the second one is referring to targeting the money supply, okay. So if the Bank of Canada's goal is to increase the target interest rate from 2% to 3%, then the most effective approach is to hit pause and select the correct answer. Okay, so the correct answer here is C. It would raise the interest rate to 3%, as shown in this diagram, and then it would sell government securities in financial markets to accommodate the decline in the quantity of money demand. Here is a good slide that reviews the concept we just tested in the previous multiple choice question, so it's a good idea to review this. It's similar to the diagram that's in our text. Okay, next question. What is the bank rate? Hit pause. Okay, the correct answer is D. It's the interest rate at which the Bank of Canada will lend funds to commercial banks. Suppose there were a large and persistent recessionary gap. An appropriate monetary policy would include which of the following? The correct answer is A. They would reduce the target for the overnight interest rate. That will stimulate investment spending, and it makes credit cheaper, so people would want to spend more. High inflation is costly to firms and individuals. It creates a lot of uncertainty, especially for firms. Of the following, who is most adversely affected by high inflation? So which of these situations here would be the worst? Hit pause. Okay, the correct answer here would be a senior whose retirement income is fixed in dollar terms. Okay, if it's fixed in dollar terms, it's not going to change at all. So if there's a high level of inflation, this person's standard of living will fall. Given its existing policy regime of inflation targeting, the Bank of Canada would likely react to a large negative aggregate demand shock, something similar to what's going on now, what would they do? Hit pause? Okay, the correct answer is they would obviously decrease the target for the overnight rate to stimulate the economy. Next question. So now we're moving on to trade. What is comparative advantage? So hit pause and decide on what the correct answer is. Okay, if you remember, comparative advantage deals with opportunity cost. So it's the advantage gained from producing something at a lower opportunity cost than other producers are able to do so. Okay, so next question. Refer to the diagram here. In this diagram, we see two production possibilities curves, one for tranquility and one for harmony, okay? And it says, what do the comparative opportunity costs in the two countries suggest? So this is a little tricky question. So you need to figure out what the comparative advantage is by first looking at what the differences in opportunity cost. So as a hint, you only need to figure out whether one country is going to specialize or not. Once you figure out what one country is going to do, you know what the other one will do. So as a hint, figure out for each country what the opportunity cost is of a pear, okay? Relative to, in terms of apples. So how much does a pear cost in terms of apples? Okay, so hit pause and spend a few minutes figuring it out. Okay, so the correct answer here is going to be C, where this is saying that harmony should specialize in pears and tranquility will specialize in apple. Why do we think that? Well, let's look at tranquility. We can look at the diagram and see that if they were to make 30 pears, how much would they have to give up of apples? Well, they'd have to give up 90 apples. So for each pear, they're giving up 3 apples. Harmony, on the other hand, if they produce 40 pears, they would have to give up 80. And so if we just look at per unit, so we divide both by 40, we find that in harmony, for them, one pear would only cost 2 apples. So since they have the lowest cost, harmony is going to specialize in pears, and so that means the other country, tranquility, will specialize in apples. Okay, so the last question. When will the supply of Canadian dollars on world markets increase? Okay, so hit pause. Okay, so the correct answer here is C, when Canadians travel abroad. So in order for there to be an increase in the supply of Canadian dollars, there has to be people who have Canadian dollars, which are Canadians, selling them to get other currencies. And C is the only example here where that happens. If we look at, for example, D, we have a Canadian exporter sells products abroad. Well, in that case, foreigners will be demanding Canadian dollars, not selling them, okay? So whenever you have a Canadian wanting to sell Canadian dollars to buy another currency, that's where you have an increase in the supply of Canadian dollars on the foreign exchange market. Okay, so I hope these were useful. These are slightly harder maybe than some of the questions from the textbook, but I thought it was a good overview of the main concepts that we covered. If you have any questions or want me to cover any particular questions, you can send me an email and I'll try to get back to you as soon as possible, okay? Well, thanks again. It was great having you in the course. Good luck on the final exam and have a great night. Bye for now.